What if I told you that right now, in 2025, thousands of traders are using the exact same strategy that generated $175 million in profits, and 95% of them are losing money? This isn't some hidden secret or expensive course. The rules are public, free, published in books, websites, even Wikipedia. Hell, Richard Dennis himself said, I could publish my trading rules in the Wall Street Journal and no one would follow them. And he was right. Just last August, a trader using the original Turtle rules captured a 118% gain on UAL in 105 days. Same month, different trader, same rules, account blown. The system that transformed 23 ordinary people into millionaires in the 1980s still works perfectly today. The S&P 500 breakout at 600 that looked weak ran to 650. NVDA's obvious failure at 400 shot to 1,000. The system works, but the humans using it don't. See, when Dennis recruited his turtles, he discovered something profound. Success in trading isn't about finding the perfect strategy. It's about becoming the person who can execute it. And after analyzing thousands of failed turtle traders, I've identified exactly 15 psychological mistakes that turn a profitable system into a wealth destroyer. These aren't complex technical errors. They're simple human behaviors that feel right but lead straight to ruin. Like taking profits too early, removing stop losses, or the most insidious one, following 80% of the rules and expecting 100% of results. Tonight, I'm exposing every single mistake, not just what they are, but why your brain is hardwired to fall for them, and exactly how to rewire yourself to trade like the 5% who actually make money. Welcome to Trading Psychology Stick, where we don't just teach you what to do, we transform you into the trader who can actually do it. Quick note, this is educational content based on market psychology research, not personalized financial advice. Your results depend on your execution, but here's my promise. By the end of this video, you'll understand exactly why you've been sabotaging profitable trades. More importantly, you'll have a clear blueprint to stop the self-destruction and start trading with the discipline of a true turtle. Fair warning, what you're about to learn might make you angry. Angry at yourself for the money you've left on the table. But that anger, channel it into discipline, because starting tomorrow, you'll never make these mistakes again. Mistake number 1, the genius complex. You think you're smarter than a 40-year proven system. Picture this scenario. You discover the turtle rules. Buy 20-day breakouts. Exit on 10-day lows. Use ATR for stops. Your immediate reaction? That's it? My grandmother could do this. Let me add some indicators to filter out the bad trades. Congratulations, you just signed your account's death warrant. The data is brutal. Backtests show the original turtle strategy underperformed over the last 20 years. Know what performed even worse? Every single optimized version traders created. Adding RSI filters, volume confirmations, Fibonacci levels, all consistently underperformed the original. Case in point, August 2024. A trader using the original unmodified rules captured 118% on UAL in 105 days. Meanwhile, forums overflow with improved versions that can't break even. Michael Gibbons, successful trend follower, shares this gem. I stopped looking at news in 1978. A friend worked for the largest commodity news service. His major story was about sugar. When I asked how he knew all this, he said, I made it up. That's your sophisticated edge. Fiction. Richard Dennis tested this relentlessly. Rules made money, human judgment lost money, not sometimes, always. He said, the better part of the whole thing was rules. The things that didn't work were judgments. Reality check. Your need to modify stems from ego, not logic. Following someone else's simple rules doesn't make you feel special. This intellectual vanity has destroyed more accounts than all market crashes combined. Tomorrow's assignment, write the original rules on paper. No modifications, no improvements, just the original rules. That's your new trading constitution. Mistake number 2, the crystal ball delusion. You predict instead of react. Every missed breakout has the same story. It doesn't look right. Volume's too low. RSI is overbought. Translation. You're cosplaying as a fortune teller, and fortune tellers don't drive Lamborghinis. They drive Toyotas. Use Toyotas. Cold hard math. Research shows 50 to 67% of breakouts fail immediately. Your gut feeling would be right 2/3 of the time. So, why take every signal? Because the 33% that work generate returns 4 to 5 times larger than the losses. You can be wrong twice as often as you're right and still print money, but only if you take every setup. The SPY 600 breakout in 2025 tells the whole story. Twitter analysts called it weak, low volume, overbought, terrible breadth, classic fake breakout signals. It ran to 650 without looking back. Truth bomb? Nobody can predict which breakout succeeds. Not you, not Goldman Sachs, not the Fed. The turtle system embraces this reality. It admits, I don't know which trade will work, so I'll take them all with proper risk management. Dennis was crystal clear. Look at prices rather than relying on information from television or newspaper commentators. He knew predictions were worthless theater. Price was the only truth. The psychology is simple. Skipping trades protects your ego from being wrong. Your mind creates elaborate justifications for why this setup doesn't look right. But the market doesn't care about your feelings or your analysis. Jesse Livermore died broke. Why? He switched from reacting to predicting. George Soros made billions following price, never forecasting it. Starting today, take every valid signal, let probability work. Stop trying to outsmart randomness. Mistake. Number 3, the action addiction. You equate movement with progress. Quick audit. How many trades did you place last week? If it's over 3, type overtrade in the comments. No judgment. Awareness is the first step. Jerry Parker places 10 to 15 trades per year. The average losing trader? That many per week. The difference isn't skill. It's understanding that trading isn't a video game where more action equals more points. Your brain treats trading like a slot machine. Every click releases dopamine. Every filled order feeds the addiction. You're not trading for profits anymore. You're trading for the high of trading. Parker's been running Chesapeake Capital since 1988. 3 decades of consistent profits. His edge? Diversification and taking small losses. That's really the secret for surviving. Notice what's missing. No mention of finding more trades. The uncomfortable math. Markets trend 20% of the time. That means 80% of the time. The correct trade is no trade. But try explaining that to a brain raised on TikTok and instant gratification. Let's do the damage calculation. Trade 200 times versus Parker's 15. You pay 13x more in commissions. Face 13x more slippage. Make 13x more emotional decisions. Expose yourself to 13x more random noise. Your profits? Not 13x, usually negative. Those extra 185 trades aren't opportunities. They're boredom manifesting as analysis. Revenge trades dressed up as setups. FOMO, wearing a technical indicator costume. One former turtle confessed. For most of us, it was just pleasing rich. They wanted to show they were working, analyzing, grinding. But Dennis didn't want activity. He wanted discipline. New mantra. The best trade is often no trade. Success means doing less, not more. Mistake number 4, the premature profit panic. You grab 1R profits in a 10R world. Watch this mental movie. AAPL breaks out at 180. You buy. 3 days later, you're up $500 on a 10,000 position. Your brain starts its fear campaign. That's a car payment. Lock it in. What if it reverses? So, you sell at 182. Pat yourself on the back. AAPL continues to 190, then 200, then 210. You left 3,000 on the table to protect 500. You saved a car payment, but lost a vacation. The original turtles were trained to watch 20%, 50%, even 100% of open profits evaporate. Most traders would rather eat glass. That's precisely why most traders stay broke. The math doesn't lie. Average turtle winner ran 4 to 5 times larger than average loser. Not because they were lucky, because they let winners run while you're taking profits at 1R like it's Black Friday. Richard Dennis hammered this home. Don't focus on being right. Focus on making money when you are right. Being right isn't the goal. Being massively profitable when you're right is. Let me paint the painful picture. If your average loss is $1,000 and you always take profits at 1,000, you need a 50% win rate just to break even after costs. But let winners run to 4,000, You can be wrong 70% of the time and still profit. The psychology is predictable. You're so traumatized by previous losses, so terrified of giving back gains, that you sabotage the very trades that could pay for all your mistakes. Next time you're in profit, ask yourself, am I exiting because the trend ended or because I'm scared? Fear is not a trading signal. Mistake number 5, the stop loss allergy. You remove stops thinking you're giving trades room. Nick Leeson had a theory. Stop losses were for amateurs. Professionals managed risk with experience and judgment. His professional approach vaporized Barings Bank, a 233-year-old institution, in weeks. The story always starts the same. If I just give it more room, it'll come back. These famous last words have blown more accounts than all black swans combined. Turtle rules demanded something radical. Set your stop loss before entry, not after. Not adjusted based on price action. Before. One turtle got fired for violating this. No excuses, no exceptions. The stops used ATR, average true range. Volatile markets got wider stops. Quiet markets got tighter stops. Pure math, zero emotion, no negotiation. Plot twist. Curtis Faith, the superstar who banked $31.5 million more than any other turtle, seemed untouchable. By 2022, that same superstar was arrested as a homeless man in a Boston shelter. From millions to homeless. How? Simple. He stopped honoring his stops. The psychology is seductive. Moving a stop feels like flexibility, but it's actually weakness. You're choosing temporary comfort over permanent survival. You're betting hope against mathematics. Professional traders know the truth. The stop loss is your business partner. It's the bouncer keeping you out of trades that could end your career. It's the insurance policy that guarantees you'll still be trading next year. Leeson's bank survived Napoleon, 2 world wars, the Great Depression. One trader without stops killed it in 3 weeks. Before your next trade, write your stop on a post-it. Stick it on your monitor. That number is sacred. Move it tighter? Fine. Move it wider? Never. Quick pause. We've covered 5 critical mistakes. The genius complex, crystal ball predictions, action addiction, premature profit panic, and stop loss allergy. Notice the pattern? Each mistake feels smart but leads to ruin. Take a breath. This is heavy material, but you're still here. That already separates you from the quitters. Fun fact, a turtle shell isn't for hiding, it's for protection while moving forward. That's your new trading philosophy. Ready for the next level? Let's go. Mistake number 6, the drawdown denial. You can't accept that winning systems have losing periods. December 2023 was brutal for trend followers, down 15% across the board. Forums filled with obituaries. Trend following is dead. Markets have evolved. The edge is gone. The quitters locked in losses and switched to mean reversion strategies. January 2025 arrived. China announced stimulus. Every market exploded in trends. Commodities, currencies, indices, all printing money. The patient traders who endured December's pain captured 40% gains. The quitters, still waiting for better conditions. Expecting a profitable system without drawdowns is like expecting a relationship without arguments. Good luck with that fantasy. The probability lesson most refuse to learn. A system with 40% wins and 2.5 to 1 reward risk will have losing streaks of 10 plus trades. Drawdowns of 20 to 30%. This isn't failure. It's statistics. Jerry Parker navigates this brilliantly. He admits, markets since 2008 have been the most challenging, yet he's still profitable after 3 decades. Why? He understands drawdowns aren't bugs, they're features. Consider Richard Dennis, the legend who spun 1,600 into 200 million, lost over half his wealth from 1987 to 1988. System broken? No. Markets shifted from trending to choppy. Same system that printed fortunes in trends lost money in ranges. The critical insight, Dennis expected this. He prepared his turtles for it. Markets cycle between trending and ranging. No system captures both. You make fortunes in your season and survive the off-season. If systems made money monthly, everyone would use them. The edge would vanish. Efficiency would kill profits. Drawdowns shake out weak hands, preserving opportunities for the disciplined. George Soros pulled $2 million from Dennis after 2 bad months. Dennis made $80 million in 1986. Soros built his billions elsewhere, but imagine if he'd stayed. Drawdowns are tuition. Pay them to stay enrolled in the game. Mistake number 7, the leverage lunacy. You think 10x leverage equals 10x profits. Time for honesty. What's your risk per trade? Don't know instantly? Calculate it now. Over 2%? You're juggling chainsaws. Drop your number in comments. Let's keep each other alive. The math should terrify you. At 1% risk per trade, expect 32% annual returns with 41% maximum drawdown. Bump risk to 5%. Returns jump to 76%, but drawdown explodes to 97%. Let that sink in. 97% drawdown means your 100,000 account becomes 3,000. To break even requires 3,233% returns. That's not trading, that's assisted financial suicide. The turtle rules were explicit. Never exceed 2% risk per trade. Not a suggestion, a survival requirement. Mathematics doesn't care about your impatience. Traders tell themselves beautiful lies. They're different. They'll stop before maximum drawdown. They'll adjust when things go badly. No, they won't. The death spiral looks like this. Trade 5% risk. Hit a normal 5-trade losing streak. Down 25%. Panic sets in. Must make it back. Increase to 7% risk. Another loss. Down 32%. Now you're desperate. Risk 10% for the comeback. Account death in 3, 2, 1. The turtles used volatility-based position sizing. ATR determined how much markets moved. Position size adjusted so daily movement equaled consistent risk across all markets. More volatility meant smaller positions. Less volatility meant larger positions. Always respecting that 2% ceiling. Professional wisdom. There are old traders and bold traders, but no old bold traders. The bold ones betting 10% per trade, they're not trading anymore. The old ones grinding 1 to 2%, still collecting checks. New rule, risk small, win big. Slow money is still money. Fast money is usually no money. Mistake number 8, the pyramid phobia. You fear adding to winners, but love averaging losers. The amateur playbook. Stock drops. Buy more to lower your average. Stock rises. Take profits to lock in gains. Congratulations, you've got it perfectly backwards. The turtle edge wasn't the entry. It was pyramiding up to 4 units into winners. Let me show you why this matters. MSTR breaks out at 400. Unit 1, 25 shares. At 420, add Unit 2. At 460, Unit 3. At 500, Unit 4. Total position, 100 shares, average price, $45. MSTR runs to 600. The turtle exits with $15,500 profit. The typical trader who bought once at 400 and locked in at 480 made 2,000. Same trade, same direction. Nearly 8x difference in profit. The principle is elegant. Add to winners because they're proving themselves right. Every new high validates your thesis. By Unit 4, you have maximum exposure to your best performer. Meanwhile, averaging down is doubling down on being wrong. It's throwing good money after bad. It's hope masquerading as strategy. Dennis taught the distinction. The market pays you to be right, not to prove you were right. Adding to winners multiplies correct decisions. Adding to losers multiplies mistakes. Jerry Parker reveals why this is so hard. For most turtles, it was just pleasing Rich. They pyramided because Dennis demanded it, not because it felt natural. Left alone, most would have taken quick profits. The psychological barrier. When MSTR hits 460 and you're up 500, every instinct screams, protect these gains. The professional says add more exposure to this proven trend. Your winners deserve more capital, not less. Your losers deserve the exit, not rescue attempts. Mistake number 9, the hot tip hunter. You abandon system for inside information. Your brother-in-law texts, "My friend at Goldman says tech is going higher." By the time you get this inside information, you're not early to the party. You're the dessert course at Smart Money's exit feast. The turtles used zero fundamental analysis, zero news, zero tips, just price action. They banked $175 million while CNBC addicts went broke. Michael Gibbons drops this truth bomb. I stopped reading news in 1978. A friend was the top reporter at a major commodity service. His big story was about sugar's future. When I asked how he knew, he said, "I made it up." Made it up. That's your edge. Fiction sold as fact. The turtles proved something revolutionary. You don't need inside information. You need inside discipline. They knew nothing about heating oil fundamentals, soybean crop reports, or Fed thinking. They knew one thing: is price breaking out? Richard Dennis was fanatical about this. Look at prices rather than relying on information from television or newspaper commentators. This wasn't advice, it was law. The information paradox. If it's truly valuable, you won't hear it. If you're hearing it, it's worthless. The market already digested every fact, rumor, and whisper. It's all in the price. Every time you chase a tip, you're saying your tested edge isn't as good as someone's random story. You're trading statistical probability for narrative gambling. The market is the ultimate information processor. By the time you hear anything, 1,000,000 algorithms and 1,000 institutions already traded it. The only insider information that matters is already on your chart. Mistake number 10, the optimization obsession. You backtest perfect parameters for past data. Optimization is educational fraud. You're teaching your system to cheat on a test that will never be given again. The evidence is damning. Backtests show turtle rules underperformed from 1996 to 2009. Traders see this and start tweaking. Test 17-day entries, 23-day entries, different stops. Eventually, they find gold. 23-day entry with 13-day exit beats the original by 40%. They go live with confidence. Reality delivers a beating. The optimized parameters only worked because they randomly fit historical quirks. When patterns shift, and they always shift, the system implodes. Meanwhile, traders who grasp the concept, rather than the parameters, keep profiting. They didn't change 20 to 23 days. They understood trend-following works and adapted the philosophy to modern markets. Dennis chose round numbers deliberately. 20-day breakout, 10-day exit. Not because they were optimal, because they were robust. They worked adequately everywhere, not perfectly anywhere. The 20-day parameter captures a human constant, roughly 1 month of trading, long enough to filter noise, short enough to catch trends. It worked in the 1980s, works today, will work in 2030. Professional system developers test for robustness, not perfection. They want strategies that survive all conditions, not dominate past conditions. Good enough consistently beats perfect temporarily. Every parameter tweak is another nail in your strategy's coffin. You're not finding edge, you're finding noise. And noise never repeats. The best parameter, the one that works adequately everywhere. You're crushing this. 2/3 complete. Most viewers would have quit by now, but you're different. You're proving you have what it takes. Real turtles can live over 100 years. Not because they're fast, but because they're consistent. Your trading longevity depends on the same principle. Ready for the final 5? These are the career killers. Mistake number 11, the market timer's curse. You try to turn off the system during bad markets. George Soros, brilliant as he was, pulled $2 million from Dennis after 2 bad months. Dennis proceeded to make $80 million in 1986. The lesson? Even geniuses can't time when systems will work. Missing the best 10 days per decade cuts returns by 50%. Guess when those days occur? Right after the worst ones. Your attempts to avoid pain guarantee you'll miss gains. December 2023 tortured trend followers, down 15% minimum. The chorus was deafening. Trend following is dead. Markets have changed. Too many algos. Those who went to cash missed January 2025's explosion. China stimulus ignited trends everywhere. Patient traders who endured December's punishment captured 40% gains. The timers? Still waiting for clear signals. Jerry Parker survived 3 decades using one approach. Through dot-com bubbles, through 2008, through COVID, his secret isn't timing, it's showing up. Parker's philosophy, diversification and taking small losses. That's really the secret. Notice what's absent? Any mention of predicting good or bad markets. The timing paradox. Systems work best after they've struggled. They struggle after working great. Human nature does the opposite, piling in after profits, bailing after losses. Picture this. After 18 months of drawdowns, every cell screams, "This isn't working." Your spouse questions your sanity. Friends mock your stubbornness. Evidence seems overwhelming. That's precisely when discipline matters most. The greatest fortunes weren't made timing markets. They were made surviving them. Buffett doesn't time. Renaissance doesn't time. They show up daily because time in the market beats timing the market. Your job isn't predicting when the system works. It's being there when it does. Mistake number 12, the selective memory syndrome. You remember wins vividly, forget losses existed. Challenge time, journal your next 10 trades, just 10. Entry reason, exit reason, result. Return in 2 weeks and share what patterns you discovered. Type journal if you're in. Memory is marketing. Your brain runs a propaganda campaign where you're always the hero and losses were flukes. William Eckhart taught this critical concept. You shouldn't care about how you got to the current state, but rather about what you should do now. But without records, you can't see the current state clearly. The turtle win rate was 38 to 40%. Less than a coin flip, yet it printed millions. How many traders would stick with that reality without documenting the massive winners offsetting frequent losers? Your brain's creative accounting. That TSLA trade where you made 3,000, vivid, crystal clear. The 5 attempts before losing 600 each, fuzzy, somehow forgotten. Net result, 0, your memory, crushed TSLA. This isn't conscious deception, it's unconscious protection. Your ego can't handle the truth that trading is hard. You're usually wrong, and success comes from grinding mathematical edge over hundreds of trades. The turtles documented everything: entry reason, exit reason, emotional state, market condition, not for Dennis, for themselves, to combat the fiction their brains would otherwise create. Without a journal, you're flying blind, navigating by feelings instead of facts. Your feelings about your trading are always wrong. Always. Only data tells truth. Only records reveal patterns. Only documentation drives improvement. Mistake number 13. The halfway hero. You follow 80% of the rules and expect 100% of results. Dennis nailed it. Almost anybody can make up a list of rules that are 80% as good as what we taught. What they couldn't do is give them the confidence to stick to those rules when things are going bad. Trading systems are like flight checklists. Skip 20% of pre-flight checks and your plane might fly, or it might crash. And want to find out at 30,000 feet? The shocking truth: multiple turtles failed despite having identical rules. Same teacher, same capital, same system. Completely different outcomes. Why? They followed most rules most of the time. They'd use 23-day breakouts instead of 20, close enough. Risk 3% on high conviction trades, just this once. Exit early when the trend felt exhausted. Skip signals after losses to be selective. Each modification seemed minor, reasonable, even smart. Combined, they transformed a profitable system into expensive gambling. Forum posts reveal this constantly. I use turtle rules, but with 23-day breakouts. That's not turtle trading. That's a completely different untested system wearing a turtle costume. Every rule exists for a reason. The 20-day breakout, validated across decades. The 2% risk, optimized for survival. The pyramid rules, maximizes trend capture. Your improvements are untested hunches fighting proven mathematics. Partial compliance creates unknown risk. You can't debug a system you're not following. You can't trust results from bent rules. You can't achieve someone else's success with your interpretations. Excellence means doing ordinary things with extraordinary discipline. Mistake number 14, the system hopper's doom. You collect strategies like Pokemon cards. The pattern is everywhere. Try turtle trading, hit drawdown. This worked in the 80s, but markets changed. Switch to mean reversion. Works until trends develop, account shredded, markets two-directional now. Try Elliott wave, then supply and demand. Then ICT, then SMC. 2 years pass. 6 systems attempted. 0 profits earned. The tragedy? Every abandoned system had profitable periods after you quit. You experienced each system's pain, but none of their gain. Jerry Parker's used essentially the same approach since 1988. Through every market condition, through every death of trend-following article, still profitable, still trading. His edge isn't the perfect system. It's the perfect commitment to one system through all its seasons. System hopping is like changing grocery store lines. The moment you switch, your old line speeds up. You're perpetually in the wrong place at the wrong time. Not from bad luck, from bad discipline. Success comes from dancing with one partner through the entire song, not switching every time you step on their toes. Every system has rough patches. Profits come from surviving them, not avoiding them. Parker dances with trend following, Buffett with value investing, Renaissance with mathematical patterns. All have rough periods, all survive them, all prosper long term. The next system isn't better, just different. Mastery comes from depth, not breadth. Mistake number 15, the knowing-doing gap. You know everything but execute nothing. This is the final boss, the ultimate destroyer, and it has a name. Curtis Faith. Faith made $31.5 million as a turtle, most successful by far, youngest by far. He literally wrote the book on turtle trading. Every rule explained, every secret revealed. By 2007, his fund lost 70%. The CFTC banned him from trading. By 2022, the Wall Street Journal's Golden Boy was arrested as a homeless man in Boston, from $31.5 million to homeless. What happened? Simple. He stopped following his own rules. Faith started. Acceleration Capital convinced he could improve Dennis's teachings, added complexity, adjusted based on experience, took bigger risks because he was Curtis Faith, the superstar. The market didn't care about his reputation. It destroyed him. This terrifies me more than any crash, because it proves knowing everything provides zero protection without discipline. Education without execution equals expensive entertainment. Every trader faces this gap. You've read the books, watched the videos, understand the concepts. You know exactly what to do. Then real money meets real markets and your knowledge evaporates. The market doesn't care what you know, only what you do. The hardest part isn't learning the rules. It's following them when following them hurts. Your education is complete. Now only execution matters. There are no more lessons, only actions. Choose your worst mistake from these 15. For your next 10 trades, focus on fixing only that mistake. Master one before moving to another. You've just discovered the 15 psychological mistakes that turn profitable systems into account destroyers. From the genius complex that makes you overcomplicate simplicity, to the knowing-doing gap that destroyed Curtis Faith after he made $31.5 million. Each mistake is a mirror, showing exactly why discipline beats intelligence in markets. Remember, the system that made $175 million still works. That UAL trade in 2024 proved it, 118% in 105 days. The only variable is you. Which mistake has been killing your discipline? Drop the number in the comments. I read every single one, and the honesty in this community continues to blow me away. Want to stop sabotaging yourself? I've created the Ultimate Turtle Trader's psychological checklist, all 15 mistakes with daily exercises to build discipline, plus the exact original rules Dennis taught, word for word, free download in the description. Next week's video, Jerry Parker opens his actual positions at Chesapeake Capital. See exactly how the most successful living turtle still trades after 37 years. Real positions, real explanations, hit subscribe and the bell. Remember this, Richard Dennis said, I could publish my trading rules in the newspaper and no one would follow them. Prove him wrong or prove him right. The choice is yours. Trade with discipline, stay humble, and I'll see you in the next one. He sent me a screenshot. Breakout, clean structure, RSI confirmation, volume spike, classic. Then, silence. 15 minutes later, hit SL, market's rigged. But what if I told you, it's not rigged, it's rehearsed? Welcome to Trading Psychology Stick, where we decode the mental game behind every trade. Quick note, this isn't financial advice, just one trader sharing hard-won insights with another. See, we're taught to look at price like it's reality, like it's the truth. But what if price is just a stage light, a decoy, a distraction? What if everything you've learned was just the front row view of a theater? Lights, music, tension, drama, meant to keep you watching, reacting, buying your next ticket. What if the breakout wasn't a signal, but a scene? What if the stop loss you just hit wasn't random, but scripted, perfectly to include you? Because here's the truth. The market isn't chaos, it's choreography. Every fake out is an act. Every new spike is a sound effect, and every time you feel certain is when you're about to get cast as the fool. This isn't about learning more indicators. This is about reading the script behind the price. This video isn't just another trading theory. It's a backstage pass. And once you step behind the curtain, you'll never watch the chart the same again. You're not here to win by luck. You're here to stop playing the wrong role. And the first step, knowing that what looks obvious is often staged. By the end of this video, you'll be able to read the chart like a director, not a desperate extra. And the next time the market sets a trap, you'll smile, because you'll already know the lines. Section 1. The brightest light hides the deepest trap. You ever notice how the moment everything looks perfect is exactly when it goes wrong? That's not irony, that's design. Price breaks out, momentum's strong, news supports the move, everyone's on board, and just as you click buy, convinced this time is different, boom, reversal. Stop hunt, you're out. Then it goes your way. Without you, that's not a mistake, that's a scene. Let me show you exactly what I mean. Pull up EUR/USD on the H1 chart from last Tuesday's London session. Price had been consolidating between 1.0850 and 1.0880 for 6 hours. Then, at 8 a.m. GMT sharp, massive green candle breaks above resistance. RSI shoots to 72. Volume triples. Twitter lights up, EUR breaking out. But look closer. That resistance at 1.0880, it aligned perfectly with the previous week's high, a classic external liquidity pool. Smart money had been accumulating sell orders there for days, waiting. The breakout? It was engineered to trigger retail buy stops, creating the exact liquidity needed for institutions to offload their positions. 2 candles later, complete reversal. Price drops 80 pips in 15 minutes. Every breakout buyer trapped. Every stop loss hit, the theater emptied, and smart money walked away with the profits. Have you ever been trapped by a perfect setup that reversed immediately? Type trapped in the comments if this sounds painfully familiar. But here's the key. Not every breakout is a trap. The difference, context, volume, and timing. Real breakouts happen with sustained volume, during optimal trading hours, and often after periods of genuine accumulation, not theatrical consolidation. The market's not reacting to your decisions. It's setting the stage for them. The breakout? It wasn't a gateway. It was a spotlight. And the moment you stepped into it, the trap door opened. See, breakout traders are like the audience in a magic show. They cheer when the magician says, "Now, watch closely." But they're never watching the right hand, because the right hand is meant to dazzle. The real move is hidden in the shadows, where the trick actually happens. Here's a practical strategy. The fade the breakout technique. Wait for that explosive breakout everyone's chasing, then watch for the retest. If price returns to the breakout level and shows rejection, weak candles, long wicks, decreasing volume, that's your signal. Enter short with your stop just above the high. Target, the origin of the consolidation. Risk 1% of your account, no more. The worst part about these traps, they work because they feel like you were right. You had the pattern, you had confirmation. But it wasn't your pattern, it was theirs. And you weren't confirming anything, you were fulfilling a role. Here's something most educators won't tell you. That consolidation before the breakout, that's where smart money accumulates. They're not waiting for the breakout, they're creating it. Building pressure like a director builds tension. And when retail finally sees the obvious move, that's their cue to distribute. Quick mental checkpoint. We've discovered that breakouts can be orchestrated liquidity grabs, but context and volume help distinguish traps from genuine moves. Still tracking? The smart money doesn't enter on the breakout. They engineer it. They build the narrative, draw the crowd, and then vanish, leaving you wondering why the lights just went out. And once you realize this, something shifts. You stop reacting to the action. You start reading the motive. You stop chasing certainty, and you start spotting choreography. The next time you see a breakout, pause. Ask yourself, who wants me to believe this? What's the broader context? And what role am I being cast into? Because if you can't answer that, you're probably not the director. And if this just opened your eyes to how theatrical breakouts really are, wait until you see what happens when the whole audience claps at the wrong time. Section 2. When everyone claps, the curtain's about to fall. There's something strange about applause. It always comes just before the scene ends. Remember GameStop in January 2021? When every Reddit trader, Twitter influencer, and your uncle who never traded suddenly agreed, this is going to the moon. The stock hit $483. Euphoria everywhere. And then, down 90% in 2 weeks. The curtain didn't just fall, it crashed. Or take Shiba Inu in October 2021. Crypto Twitter exploded. SHIB to 1 cent was trending. Elon tweeted, "Exchanges crashed from demand." But check the on-chain data from that week. Large wallet addresses were distributing, not accumulating. While retail bought the dream, smart money sold the reality. Think about the last time you felt completely sure of a trade. Maybe you saw it on social media. A wave of influencers suddenly agreed, "This is the breakout we've been waiting for." The volume surged. You felt that little electric jolt of FOMO. You clicked in, and then nothing. Price reversed. You got stopped. And the silence that followed, that was the sound of the curtain dropping. The truth is, when the crowd agrees, the scene is already over. Because markets aren't moved by opinions. They're moved by liquidity. And nothing generates liquidity like mass belief. You weren't part of a trend. You were part of an exit strategy. Comment below, have you ever bought something because everyone else was excited about it? What happened next? Let's get specific. GBP USD, March 15th, New York session. UK inflation data beats expectations. Cable shoots up 120 pips in 10 minutes. Financial Twitter goes wild. GBP moon mission. Retail orders flood in at 1.2450. But here's what the crowd missed. That spike took price directly into the previous month's high at 1.2465, a massive sell-side liquidity pool. Smart money had resting orders there for weeks. The bullish news was just the catalyst to drive price into their distribution zone. Result? Violent rejection. 200 pip drop in 3 hours. Every late buyer liquidated. The news was real, but the move was theater. Here's where it gets interesting. You know what we call those previous highs and lows in smart money concepts? Liquidity pools. Think of them as audience seating charts. Equal highs, that's a sold-out show. Equal lows, standing room only. And smart money, they're not buying tickets, they're collecting them. But remember, consensus isn't always wrong. During strong trends, the crowd can be right for extended periods. The key is distinguishing between early trend consensus and late-stage euphoria. Early consensus happens quietly. Late-stage consensus screams from rooftops. So, why does this keep happening? Because we forget something crucial. If it's visible to everyone, it's priced in. If it feels easy, it's bait. If it feels popular, it's late. The market loves to reward conviction, just long enough for it to become consensus. Then it punishes the crowd for clapping too soon. This is why real traders don't look for confirmation. They look for confusion. They enter where others hesitate, not where others cheer. Because they know, the loudest applause comes right before the lights go out. Here's a practical approach. The consensus fade strategy. When you see overwhelming agreement on social media about a move, wait. Let the first wave of enthusiasm pass. Then watch for exhaustion signs, decreasing volume, weakening momentum, rejection at key levels. That's often where the real opportunity lies, in the opposite direction. Quick reality check. So far we've seen that breakouts can be staged, and crowd agreement often signals distribution, not accumulation. But context matters. Not all consensus is terminal. Starting to see the nuanced picture? You want to trade like the smart money? Stop looking for agreement. Start looking for conflict. Find the moment when price makes people feel uncertain, not euphoric. That's usually where the truth begins. The market loves this game. It's like a comedian who waits for the audience to lean in before delivering the punchline. Except here, the punchline is your stop loss. So next time you feel the market is finally clear, take a step back. Ask, why does it feel easy now? And who might be exiting while I'm entering? Because applause may feel good, but on Wall Street, when everyone claps, someone's already leaving through the back door. And if you think this was revealing, wait until you realize the market doesn't just fake direction. It also fakes intention. You stare at the chart. The candles push up hard. Displacement, break in structure, FVG below. You hesitate. Is this the real move or another act? Let me show you something that changed how I trade forever. Bitcoin, December 2023, 4-hour chart. Price breaks above 42,000 with authority. Clean market structure shift, bullish order flow. Then it drops back, fills the FVG at 41,200, consolidates for 8 hours. Most traders gave up. Failed breakout, they said. But watch what happened next. Price exploded to 48,000 in 2 days. That wasn't a failed breakout. It was a textbook inducement. The initial spike above 42,000, that was to trap early shorts. The drop to 41,200, that was to shake out weak longs. The consolidation, that was accumulation disguised as indecision. Because once you see the market for what it is, a theater of intention, you stop asking where price is going and start asking why it's going there that way. See, most traders still believe price is truth, that if something breaks structure, it's real. But structure alone doesn't reveal intent. It reveals choreography. A price push isn't confirmation, it's an invitation to misinterpret. Let me introduce you to a concept that changed everything for me: inducement. It's when the market shows you exactly what you want to see: a break of structure, a confirmed trend change, just to pull you in before the real move begins. Think of it as the false climax before the actual plot twist. Here's a real example. Gold on M15 during London session. Price breaks below B1950, taking out the Asian session low. Sellers pile in. But look at the volume. It's decreasing, not increasing. That's your first clue. Then price quickly recovers above 1950 and consolidates. 2 hours later, massive push to 1975. That break below 1950 wasn't a bearish signal. It was inducement to trap sellers and create buy-side liquidity for the real move-up. The smartest money in the world, the ones who don't flinch. They don't just look at the candle. They look at when it appeared, how it moved, what it violated, and most importantly, who just got trapped. Type inducement if you've ever been faked out by a false break that reversed to trap you. Let's see who's experienced this theater. Here's what most don't understand about fair value gaps. They come in flavors: CB, sell-side imbalance, buy-side inefficiency; busy, buy-side imbalance, sell-side inefficiency; and regular FVGs. Each tells a different story about who's in control and what's coming next. But if you're just looking for gaps to fill, you're reading the subtitles while missing the performance. Not every gap gets filled. Not every imbalance matters. Context is king. An FVG created during high-impact news often stays unfilled. An FVG during quiet accumulation usually gets revisited. Learn to read the story, not just the sentences. Because this market isn't about logic. It's about pressure, rhythm, deception. It knows that humans react to tempo, to patterns, to scenes. And if you're reacting to price instead of listening to what it's setting up emotionally, you're acting on cues you weren't meant to see. Time for a breather. We've uncovered 3 acts so far. Breakouts can be traps, but context matters. Consensus often signals exits, but not always. And the market uses inducement to build liquidity. Still with me? Here's the pivot. You must stop trading the surface. Begin sensing the script. A candle isn't a signal. It's a sentence. A displacement isn't an invitation. It's a declaration that something has shifted in the internal narrative. So, what if you began watching the market like a play, not fixating on what's happening, but on what the scene is trying to evoke? Because real trading isn't about reacting faster. It's about noticing the setup behind the setup, the misdirection, the pacing, the unresolved tension that demands a resolution. And just when you begin to read the market that way, you'll stop seeing breakouts as entries and start recognizing them as monologues, trying to convince you of something that isn't real. Now, if price can fake direction and intention, what else could it disguise? Section 4. The masks of smart money. There's a strange moment that happens right before the market turns. A calm. A kind of silence on the chart. The candles slow down. The volatility fades. Most people think it's indecision, but it's not. It's the actors changing masks backstage. Let me show you exactly what this looks like. Tesla stock. September 2023. Daily chart. After a strong rally to 280, price enters a tight range between 275 and 285. Volume dries up. Retail traders get bored. Dead stock, they say. Forums go quiet. But underneath, check the dark pool data. Massive accumulation happening. Block trades in the millions. Smart money wasn't being indecisive. They were loading up while wearing the mask of weakness. 3 weeks later, Tesla breaks out to 340. Those who waited through the boring phase caught a 20% move. Because smart money doesn't just move the market. It disguises itself within it. It doesn't wear a name tag that says, I'm accumulating now. It plays roles. It appears weak when it's about to act strong. It sells to trigger panic, just to buy it all back in silence. That's why most traders enter right after the smart money exits. They're watching the mask, not the eyes underneath. Let's dive deeper into these masks with real examples. The accumulation mask. Wyckoff called it right, but here's how it looks today. Apple before earnings, October 2023. Price struggles at 175. Bearish news everywhere about iPhone sales. Retail sentiment turns negative. But look at the order flow. Massive call options being bought. Dark pool prints showing accumulation. The weakness was theater. Post-earnings, gap up to 190. The distribution mask, even more deceptive. Nvidia at 500 in February 2024. Every dip bought aggressively. Retail euphoric. Going to 1,000, they scream. But check the insider sales. Massive. Check the call-put ratio, shifting bearish. The strength was distribution in disguise. 2 weeks later, down to 420. And those multiple types of order blocks, let me show you. Bullish order block. The last down candle before a strong move up. But here's the key. It needs to take liquidity below it first. EUR USD, Asian session low gets swept, then massive push-up. That sweep wasn't failure. It was fuel gathering. Breaker block. When a bullish OB fails and becomes bearish. Gold breaks above 2,000, pulls back to 1990 OB, then fails and drops to 1950. The OB transformed, change masks from support to resistance. Mitigation block, where price returns to apologize for an aggressive move. Bitcoin spikes from 40K to 43K, leaving an FVG. Returns to 41.5K to mitigate, then continues up. It's like checking if anyone noticed the costume change. Quick exercise, look at your last losing trade. Can you spot where smart money might have been wearing a different mask than what price showed? Here's a professional secret. Volume profile shows you where the audience sits. Value area, high, value area low, point of control. These aren't just levels. They're the theater's seating chart. And when price approaches these areas, it's not random. It's calculated, like an actor knowing exactly where the spotlight will hit. US 30 at the point of control from the previous week. Price struggles, retail thinks it's resistance. But smart money, they're absorbing every sell order. Once retail capitulates, boom, straight through. The resistance was just smart money's buying zone in disguise. Remember, not every quiet period is accumulation. Not every rally is distribution. You need confluence, multiple factors aligning, volume patterns, option flow, time of day, larger time frame context. The amateur waits for confirmation. The experienced trader waits for misdirection. Because that's where smart money lives, not in the clarity, but in the confusion right before the turn. So next time you see price hesitate, get quiet. Ask yourself, is this uncertainty? Or is this the mask changing? Because when you can answer that, you're not watching the play anymore. You're finally reading the script. But the most critical part of the story, it isn't the actor, it's the timing of the performance. And once you understand when the scene is set to change, everything else fades away. Section 5. Time is the stage, not the background. Price doesn't move in a vacuum. It moves on schedule. But most traders miss that because they think time is just background, something that ticks while you wait. But what if time wasn't passive? What if time was the stage itself? Let me prove it to you with data. Study any major currency pair for a month. Mark every significant move. You'll find 70% happen during 3 windows. London Open, 3:05 a.m. EST, New York Open, 8:10 a.m. EST, and London Close, 11 a.m. 1 p.m. EST. The other 21 hours, mostly noise. A liquidity sweep at 3 a.m. is just noise. The same sweep at 8:30 a.m., right when London overlaps with New York, is intention, precision, setup. Here's a specific example that cost me $5,000 to learn. AUD USD, perfect setup at 11 p.m. EST. Displacement, MSS, FVG, everything aligned. I entered, spent 4 hours watching it chop. Stopped out. The exact same setup appeared at 3 a.m. London Open. Explosive move, 100 pips in my original direction. The setup wasn't wrong, The timing was. You see, smart money doesn't act randomly. It acts rhythmically. It uses kill zones, windows of time where volume surges and emotions spike, to execute the play. But here's what most don't understand about these time windows. It's not just about London Open or New York Open. It's about the power of three: accumulation, manipulation, distribution. And these three acts happen in specific time sequences. Asian session, 7 p.m., 3 a.m. EST. Accumulation, the stage is set quietly. Range-bound price action, smart money positions itself. London session, 3 a.m., 11 a.m. EST. Manipulation, the trap is sprung, false breakouts, stop hunts, inducement, maximum emotional damage. New York session, 8 a.m., 5 p.m. EST. Distribution, the real move unfolds. Trending price action, smart money offloads to retail. This is called the AMD cycle, and once you see it, you can't unsee it. Here's a tradable example. GBP, JPY, watch it for a week. Asian session creates a range. London opens, immediately spikes above the range, manipulation, then reverses hard and trends down through New York, distribution. Like clockwork. The script rarely changes, only the actors. Comment AMD if you've noticed this pattern, but didn't have a name for it until now. Here's something wild. The interbank price delivery algorithm, IPDA, runs on a schedule. Every 20-day cycle, every 40-day cycle, every quarterly shift. The market breathes in predictable rhythms, but most retail traders are holding their breath at the wrong moments. Time is what separates noise from signal. You might see the same price action 3 times in a day, but only one of them matters. The one that hits right at the market's emotional crescendo. That's when orders flow. That's when roles switch. That's when the script flips. Pop quiz. How many times have you taken a perfect setup in Asian session only to get chopped up? That's not the setup failing. That's you auditioning during rehearsal hours. The consolidation breakout strategy, time-based. Wait for Asian session consolidation. Mark the range, set alerts. When London opens, wait 30 minutes for the manipulation move, false break. Then position yourself for the real move in the opposite direction. Stop loss beyond the manipulation spike. Target, 2x the Asian range. This works because you're trading the script, not the price. Most retail traders fail not because their strategy is wrong, but because they entered during the intermission. They acted in the quiet, expecting drama, but the curtains hadn't even opened yet. So here's the shift. Stop treating time as a container. Start treating it as a signal. Track the open, track the overlap, track the volume surge. These aren't just moments. They're cues, like stage lighting, like a change in music. They tell you, something's about to begin. Let's pause again. We now understand that breakouts need context. Crowds signal exits with nuance. The market uses inducement, smart money wears masks, and time itself is the stage. Feel that paradigm shifting? But timing only gets you so far. Because even when you arrive at the right moment, you still need to know which direction the story wants to go next. And that's where the final twist comes in. Section 6. The final act begins when the crowd exits. There's a moment in every great story when the theater thins out. People check their phones. A few leave early. The energy dips. And then, boom, the twist drops. The entire plot turns. The real meaning is revealed. And those who left, they never saw it coming. Markets work the same way. Real example, crude oil, March 2024. Perfect bullish setup at 78.50. Displacement up, retrace to FVG, sitting at key support. I enter. Nothing happens. An hour passes. Chop. 2 hours. Still nothing. Twitter goes quiet. Oil is dead, someone posts. I'm frustrated. Close my position for a small loss. 20 minutes later, massive news hits about OPEC cuts. Oil rockets to 82.0. My exact setup, my exact direction. But I wasn't there for the final act. That wasn't bad luck. That was the final act. And I missed it. Not because I was wrong, but because I was impatient. Here's what actually happened in that dead period. Smart money was testing. Each small push-up, checking for sellers. Each minor dip, absorbing any remaining supply. This is called clearing the path, and it's as methodical as a stage crew adjusting lights before the grand finale. Volume profile confirmed it later. Massive accumulation in that boring consolidation zone. Point of control building right at my entry. Smart money was loading up while I was checking my phone. This is the secret few will ever tell you. Smart money uses time not just to trap, but to exhaust. They know most retail traders don't have the endurance to wait, so they bait the early move, then stall, drain your energy, erase your confidence, and when you finally give up, that's when they begin. Type patience if you've ever missed a perfect move because you gave up during consolidation. Let's see how many of us have been in this same theater. This is called time-based manipulation. The idea that intention isn't always expressed in speed, but in delayed motion. A pause that invites doubt. A stall that creates false neutrality. Want to know something that will change how you see consolidation forever? Those sideways candles aren't indecision, they're precision. Each one is a small test, a micro-manipulation, building pressure like a spring. And springs don't bounce when you watch them. They bounce when you look away. Here's a strategy for the patient. The exhaustion breakout method. After a clear displacement, price retraces and consolidates for more than an hour. Most traders leave. That's your cue to stay. Set a tight stop below the consolidation. When price finally moves, it often moves violently in the original direction. The longer the consolidation, the stronger the move. But, and this is crucial, not every consolidation leads to continuation. If price consolidates for too long, over 4 hours in a kill zone, or if it happens during off hours, the probability drops. Context, as always, is king. You begin to recognize that the real setups don't feel exciting. They feel quiet. They don't scream entry. They whisper, wait. This is where concepts like mitigation come in. After that violent move, price often returns to mitigate, to test if anyone's still believing the old story. When no one reacts, that's when the real story continues. It's like checking if the audience is still paying attention before revealing the plot twist. So the next time price slows down after a clear displacement, don't assume the story is over. Zoom out, breathe, ask, is this the end of the show or just the calm before the curtain rises again? Because patience isn't just a trait, it's an edge. And the longer you can sit in silence, the clearer the stage becomes. But even when you get the direction right and the timing perfect, there's still one more trap left. The most dangerous one. The one that doesn't come from price, but from inside you. Section 7. The enemy isn't the market. It's your script. You've read every PDF, watched every smart money video, drew every order block, timed every kill zone, and yet, somehow, the results don't match the knowledge. It's not that the market fooled you, it's that you kept reciting an old script, one that was never yours to begin with. Let me be brutally honest. January 2023, I had 10K in my account. Understood every concept we've discussed, could spot inducement in my sleep. By March, I had 3K left. Not because I didn't know, because I couldn't stop myself from knowing. Every loss triggered the same response. Double the position size. Not because the setup was better, because my ego was bleeding. I wasn't trading EUR/USD. I was trading my need to prove I wasn't a failure. One trade stands out. Gold, perfect setup at London Open. Price swept Asian lows, returned to FVG, showed rejection. Textbook. I enter with proper risk. It goes against me 20 pips. Instead of waiting for my stop, I add to the position. It has to turn here, I tell myself. It drops more, I add again. Now I'm risking 5% instead of 1%. You know how this ends. Stopped out for a massive loss. The worst part? Price eventually went my direction. My analysis was perfect. My psychology was broken. Because even when we learn advanced concepts, we carry with us the emotional blueprint of our past. The need to be right, the fear of missing out, the urge to prove we finally figured it out. But trading doesn't just test your strategy, it tests your identity. And most of us don't realize. We're trading to protect a version of ourselves we haven't let go of yet. You don't trade price, you trade your narrative about price. And if that narrative is rooted in proving, forcing, chasing, no concept will save you. This is called revenge trading, but it goes deeper than revenge. It's identity protection. The market becomes a mirror, and every loss feels like a crack in the image you're trying to maintain. Here's the risk management truth no one talks about. Position sizing isn't just about protecting capital. It's about protecting sanity. Every time you risk more than you can emotionally afford to lose, you're not trading. You're gambling with your identity. My rules now: 1% risk per trade, no exceptions. 20 trades in a row can go wrong, and I'm still down only 20%. More importantly, I can still think clearly. My ego can't hijack my decisions when the stakes stay manageable. So here's the uncomfortable mirror. Have you ever placed a trade just to feel worthy? To feel like you're improving? To feel like you belong in the real trader club? What if the biggest upgrade isn't your chart, but your inner monologue? Real talk. Who here has ever increased position size not because the setup was better, but because you needed to make it back? Drop a guilty in the comments. No judgment. We've all been there. Because once you stop needing the market to validate you, you start seeing it clearly. You become calm when others are impulsive. You become still when others chase. You become selective when others overreact. This is the difference between FOMO, fear of missing out, and JOMO, joy of missing out. JOMO is when you smile watching a movie you didn't take, because you know your setup hasn't appeared yet. It's freedom from the script that says you must catch every move. The mental exercise that changed everything for me. Before each trade, I ask, am I trading the chart or my emotions? If I feel any urgency, any need to be right, any desire to prove something, I don't trade. The market will be there tomorrow. My mental capital might not be. Quick check-in. We've revealed that markets use theatrical tricks, but discipline and proper context help navigate them. Your psychology might be the biggest factor. How's that sitting with you? That's when you stop watching the play. That's when you stop acting. That's when you become the one writing the script. And there's only one thing left to do now: tie it all together. Not just in theory, but in transformation. Section 8, your first role, the observer. So, you understand the theater, you see the traps, you recognize the masks, but understanding and executing are different stages. How do you actually trade this way? First, you accept a new role. Not the hero, not the victim, the observer. Tomorrow, when you open your charts, don't look for trades. Look for scenes. Watch one full session, London or New York, like you're watching a play. No positions, just observation. Here's your observer's checklist. Where are the equal highs and lows? Those are your liquidity pools, the audience waiting to react. Mark them. Watch how price behaves around them. When does price move fast versus slow? That's the rhythm, the difference between dialogue and action sequences. Fast moves often trap, slow moves often build. Which moves get retraced immediately? Those are the inducements, the false climaxes. Make note of where they happen and what follows. Where does price return to after big moves? Those are the mitigation blocks, the script checking if anyone remembers the last act. Real exercise I do daily. 1 pair, 1 session, 0 trades. I take screenshots every hour. End of session, I review. Where was smart money accumulating? Where did they distribute? What masks did they wear? After a week, patterns emerge that no indicator could show you. This is how you develop what I call market empathy, the ability to feel what the market is trying to accomplish, not just see what it's doing. Here's a practical exercise. Pick EUR, USD, set 4 alarms: Asian Open, London Open, New York Open, London Close. At each alarm, write down, what role is the market playing right now? Accumulation, manipulation, distribution. After 1 week, you'll see the AMD cycle clear as day. The intermediate step, paper trade with theatrical awareness. When you see a setup, ask, what act is this? Who's already trapped? What would smart money want to happen next? Where are the actors changing masks? Enter only when you can answer all 4. Your risk management becomes different too. Instead of risking 1%, you're paying for a theater ticket. Some shows cost more than others. A London Open setup might be worth a full ticket. An Asian session crawl, maybe just standing room. Position sizing example, $10,000 account. 1% risk equals $100. EUR USD setup with 20 pip stop loss. That's $5 per pip, or 0.5 lots. Simple math, powerful psychology. You can be wrong 10 times and still have $99,000. That's freedom to observe without panic. Want to really level up? Start journaling trades like movie reviews. Today's EUR USD performance featured a convincing accumulation in Act 1, followed by a predictable manipulation spike that trapped eager retail buyers. The distribution phase was textbook, complete with mitigation block encore, rating 4 out of 5 stars, would trade again. Comment below, ready to observe if you're willing to spend one session just watching, not trading. Let's see who's serious about transformation. Remember, every great director started by watching. Every successful trader began by observing. The market will always be there tomorrow. But will you see it differently? The transition from reactor to observer isn't just a strategy shift. It's an identity evolution, and it starts with one session of pure attention. Now for the final scene, the one that brings our entire story full circle. Final scene, step off the stage, pick up the script. You came in thinking price was your enemy, that smart money was this invisible villain, that you just needed the right tool, the perfect setup, to beat the market. But now, you know better. You've seen that the market isn't chaos, it's theater. And every trap, every fake out, every too good to be true move was written in advance. You learned that breakouts can be scenes, but context and volume reveal the truth. That when the crowd claps, the curtain might be falling, but strong trends exist too. That time isn't background, it's the spotlight that illuminates real opportunities. That fair value gaps, order blocks, and displacements aren't magic. They're footprints in the script that need proper context. That smart money wears masks of accumulation and distribution, but confluence helps you see through them. That patience pays better than prediction when applied with discipline. And most of all, you realize the biggest trap isn't out there. It's in here, in the voice that needs to win, to prove, to rush, to become something. But here's the final truth. Not every move is manipulation. Not every consolidation is accumulation. The market isn't always out to get you. Sometimes it's just seeking fair value. Sometimes trends are real. Sometimes breakouts lead to more breakouts. The skill isn't in seeing conspiracy everywhere. It's in distinguishing performance from reality, theater from truth. And that comes from observation, practice, and most importantly, emotional control. So, what now? Now you pause. Now you observe. Now you trade the story behind the story when the story is actually there. Because here's the truth. Real traders don't predict. They interpret. They don't react. They decode. They know when to act, and more importantly, when to wait. Not with paranoia, but with clarity. Not with ego, but with discipline. Remember, risk management isn't optional. Psychology isn't secondary. And patience isn't just waiting. It's waiting for the right moment with the right mindset and the right position size. If this message hit you, not just intellectually, but emotionally, then you're part of something rare. A trader not looking for shortcuts, but for sustainable edge. Comment below, I've stepped off the stage, so others know they're not alone. Subscribe if you're done memorizing setups and ready to start understanding context. Share this with the trader who's always almost there, but never quite sees the full picture. Join our community where we decode not just charts, but the psychology that moves them. Because the best traders aren't just technically proficient, they're emotionally intelligent and properly capitalized. The market doesn't reward those who act first. It rewards those who act wisely, those who see patterns but verify with confluence, those who understand the game but play it with discipline. Welcome to the other side of the stage. The view is clearer here, more nuanced, more profitable. And once you see it, you never go back. The play continues tomorrow. Will you be reacting to the script or finally writing your own?